This is Refined, a podcast about R&D tax credits and different perspectives. My name is Johnny Bender. I'm an independent R&D tax advisor. This episode is sponsored by taxnova.ai. In today's episode, I'm sat down with Stephen Levine, who's been working R&D for 26 years and has most recently retired from a major accountancy firm as national head and global co-head in R&D tax credits. Welcome, Steve.
Thank you, Johnny. Nice to be here.
To kick things off, I think it's always interesting to hear about how people get into the world of R&D tax credits. So if you could talk us through the very beginnings.
26 years ago, I had just joined my new firm, Chantry Vallacott in Croydon, and the then Chancellor, Gordon Brown, introduced his brand new budget. And in that brand new budget was a brand new R&D tax relief. And because we always gave a presentation to the wider team, my colleague said to me, Stephen, this is a brand new tax relief. Why don't you do this bit? It won't take you much more than 5 minutes. So I did. And a couple of months later, a client pops into the office and says, I need some help with R&D tax relief. And my colleague said, talk to Stephen. He's the expert. He knows all about it. So I've been doing R&D ever since 2000, and it's been quite a journey.
It would be interesting to go through some of the major changes because you've been working in R&D basically since the beginning of the scheme in the UK. What were the key milestones, key changes in the scheme?
I suppose the biggest initial factor was that the original guidance that came out from the revenue was very woolly. And all the claims that I submitted for the first 5 years went straight to inquiry. If we're looking at legislative changes, I would say that 2002, they extended the original rules, which are purely focused on SMEs, to large companies. Realistically speaking, those rules didn't work, and then they changed those in 2013 to the new rules, what we now know as RDEC. And there's been quite a few changes on the road since then. But I've got a sneaking suspicion you're going to ask me about some of the more recent changes later.
In 2023, there was this shocking statistic about fraud and error in the wider scheme, and that has caused ripples, big waves in terms of scheme change.
The National Audit Office started looking into the revenues handling of R&D tax credits, I think in 2021. And in 2023, as you rightly say, was the big year when it peaked at 1.1 billion. And what it meant and what it triggered was that the revenue started throwing a lot of caseworkers and inspectors at trying to reduce this fraud and error gap. I understand that prior to this increase, the national average inquiry rate was running at roughly 1.5%. After the change, it was running nearer 20. Because there was a lack of revenue enforcement or proper enforcement, it meant that a lot of people were entering the market selling an R&D tax credit to companies that probably didn't deserve to or weren't entitled to claim them.
There's a large rate of fraud and error, but it does seem like it's a really big number. Do you know how they've estimated that?
My understanding is that when the original large team of 600 caseworkers were introduced, the revenue then took 500 cases from that had been completed, and they extrapolated from those 500, and that's how they calculated the 1.1 billion. Whether or not they did that correctly is an open point, but it should be highlighted that the latest revenue forecast on fraud and error statistics now shows the underlying fraud and error at roughly 475 million, and they do refer to new methodologies in calculating that. So it's likely that they've now seen that maybe the 1.1 billion was overcooked, and maybe 475 million is more reflective. I personally think it could be still a bit toppish, but I think it's headed in the right direction.
Let's talk about the different changes that came in reaction to this big fraud and error stat.
There's been a lot of changes. First of all, prior to the changes, the bare minimum disclosure that a company need make for an R&D claim was one number in one box on one return.
Didn't have to put in any technical narrative or any sort of report.
No. Now, we always have done. I've always felt that full disclosure was the best way forward. Within the revenue rules themselves, we have to be conscious they have a power called discovery, which means if they do not have the proper information, they can open up the claim pattern for a number of years, not just 1 year, which they are normally entitled to do. So it's best practice always to submit information on projects. However, in 2023, the Revenue introduced something called the Additional Information Form. Now, what this was required the company to disclose details of projects on its largest 3 and potentially as much as 10 projects. That was a mandatory requirement, and in many cases, it was way above and beyond where disclosures were running previously. Then the next change was the claim notification form. If a company had never previously made a claim, or it hadn't made a claim sufficiently recently, the company had to submit a notice form within 6 months of the end of its counting period, telling the Revenue that it will be making a claim at some point in the near future.
Yeah, that's a big change. It keeps catching companies out.
It catches a lot of companies out, and I've seen it catch companies out which are recent inward investment, because they generally know the tax rules in the UK at least well. And in many cases, because they are starting out, even if they're subsidiaries of larger companies, they may be using smaller firms of advisors who may not know all of the rules that are relevant for some of these more major tax reliefs. And I've seen a few come to grief over this. There's also been issues where companies restructure, there can be hive downs, there can be diversification within a group, and there can be a new company pop out of nowhere within a group. And because that legal entity is brand new, unless that legal entity has made its claim notification, that can itself prevent R&D claims. The other big change, I suppose, coming out of the recent changes has to be the merged scheme rules. The UK has always been rather odd, an outlier, in that we have been the only country globally with an R&D scheme, and there's roughly 50 of them, that had 2 R&D schemes. We had an SME scheme, we had a large company scheme. And that was always painful because it introduced a cliff edge. As soon as a company went from being small and medium to large, the claim value would reduce dramatically. So it would have been great to have moved to one system. So the Revenue said, yes, we're going to have one system. And they said, everyone's going to go RDEC.
Yeah, people talked about how it's time for the UK scheme to mature.
And then a lot of smaller companies said, hang on, was getting 33% of my cost as R&D tax credit. I'm only going to get 15% of my cost as R&D tax credit. That's a lot less. So the government then thought, oh, and they introduced this intensity scheme, now known as Enhanced R&D Intensity Scheme, ERIS, as part of the merged scheme changes, and said, right, here's your rate. You can get as much as 27%. So after going through all this consultation, all these rule changes, we're back to 2 schemes.
And the mechanics of the 2 schemes pretty much resemble the SME in the ERIS and the RDEC in the merge. So
yes, the ERIS has a narrower scope. The big problem with ERIS is that it's complex.
Where does that complexity come from?
Well, it's because it's not one of the standard rules. You have to go through a whole series of steps and calculation processes. And not only that, it also works in arrears. So the calculation steps you have to do are at balance sheet date. This means that if you fall into IRIS, you generally will not know, unless you have a grace period, until after the end of the year. And if your fact pattern, if your R&D spend does not comply with the 30% intensity requirement, you fall out of it. Companies in the UK, the one thing I would say they crave, it's stability and certainty from the tax system. And I think too many governments have failed on the stability and certainty rules. I mean, as soon as they need a bit more cash, they raise taxes. And that is not good for investment. But let's now go back to IRIS. It's somewhat perverse, in my opinion, that the largest companies subject to RDEC have an easier calculation than the smaller companies, which are loss-making, which generally need the cash, actually have a more complex calculation and costs more to produce an IRIS claim than it does a normal claim. There were two other changes from the merge scheme. The first one is the cancellation of the non-UK costs. Now, there are a few welcome exceptions, but overall, I think that was a worthwhile change. I personally never really saw why the UK economy could achieve growth if we incentivize spending overseas. However, the big change under the merge scheme was for contracted out costs. The old rules were very, very prescriptive. If you fell into one bucket, the SME company could claim. If the fact pattern went a different way, the large company could claim. And there were rules covering subsidies and rules covering subcontracting. And after the most recent round of tribunal cases, I think that became a lot clearer. However, it still probably didn't give the answer the revenue wanted, so they introduced the new contracted out rules. This has changed everything, and I think this is going to be storing up problems for future years.
Why is that?
Because the R&D now belongs to the company that makes the decision to carry out the R&D process, contemplated or intended. And in a supply chain format, if the subcontractor is at the behest of the contractor, then the contractor will be able to claim all of the R&D costs that were recharged to it by the subcontractor. Whereas under the old rules, if that subcontractor had been an SME, that subcontractor would have been claiming because of the formulaic rule process. And I can really see a lot of issues going forward where an SME subcontractor may not be changing their processes and would still be claiming for something alongside the large company. And that cannot be right. When the rules were being first consulted on, the Treasury phoned me and they said, "Can we have a chat with you about these new rules?" And we said, "Of course." And they outlined the rules to us in the original draft stage. This was pre-contemplated and intended. And we said, this could get a little bit contentious. Why don't you think about making this in the contract? And therefore...
Similar to how it's done in Ireland, isn't it?
Correct. And therefore, whichever party has the entitlement within the contract makes the claim a lot more transparent. It's in the contract, they make the claim. And then it becomes a negotiation issue. So the large company may say, it's our contract, we're going to claim everything. Whereupon an SME company could say, yes, if you're claiming the R&D tax credits and I used to claim them,
our price is going to go up.
Our price is going to go up a little bit. And you can come to a happy medium. but it's transparent and only one company makes the claim.
That would
Unfortunately,
make it so much clearer and straightforward, wouldn't it?
it would have done. Unfortunately, the revenue didn't like what we said.
Is the merge scheme good for SMEs, or is it more targeted at large companies?
The companies that now call the shots are those at the top of the supply chain. And if they are the large companies, imagine a defense sector environment. You're going to have potentially the primes at the top of a supply chain. If they say they own all the R&D within that particular project, where does that leave the companies, whether they're large or small, that could be at tier 2, tier 3, tier 4, tier 5? The specialist rivet manufacturer, where are they? And they could be right down the bottom of the supply chain. But would the prime claim their R&D as well? Would they know about that particular rivet being particularly special? Who knows? I can see this being a little bit, as I said, in time, I think this will open up. But of course, there's been more changes that the revenue have done. Doesn't just stop at the merge scheme. They've also looked at the advisors. And in April this year, we saw the new sanctionable conduct rules introduced. Potentially £1 million penalty for advisors on a first-time claim that the revenue disagree with. Alongside that, there is something called GFC, Guidance for Compliance 13, which requires a different level of evidence before an advisor makes a particular claim.
It's the change that's trying to regulate the sort of unregulated advisory market.
Yes.
But it does feel a bit quite heavy-handed, doesn't it?
It feels very heavy-handed. I must admit, when I looked at those rules and I read them through, I thought, wow, they don't like someone. And in some ways, it's a little bit worrying because the professional institutes, and there's a few of them, I'm a member of 2 of them, we've been angling for years for wider adoption of the rules that we comply with, which are called the Professional Conduct in Relation to Tax Rules, PCRT. And there have been similar cut-down version rules, which the revenue have applied to non-regulated advisors, but I'm not sure there's ever been any sanctions under those rules to the non-regulated advisors. So I think there's been a little bit of a lost opportunity, and the revenue have introduced the sanctionable conduct rules as a bit of a sledgehammer. It has definitely caught the attention.
It's a new piece of legislation. What do advisors need to look out for to comply?
The advisor has got to make certain they're going to have the evidence to support the claim that they're making. Do they have the right evidence? Is it documented? Is it demonstrable? Is that advisor meeting the evidential requirement? And could that in itself trigger an action by the revenue under the new rules?
So we've mentioned AI a couple of times now. AI is here, it's changing the way people are working. How is it changing the world of R&D?
Where AI really helps is that it has enabled a good technician, a good R&D consultant, to produce their work much more efficiently. If you have got an inexperienced advisor, then I fear that the wrong output will arise. Too many technical project write-ups that revolve around functional advances rather than technological or scientific advances. And I think a lot of advisors still miss the point. They are not targeting the right information. The revenue are also using AI, and they're using their AI to spot AI within claims. They can also use AI to spot similarities between claims produced by the same advisor or in the same claimant year on year. So there's now a lot of risk coming through too much AI. A good, experienced advisor will always add value to the claim process.
From the claimant's perspective, they need to have the right competent professional. They can't just rely on AI. If you treat AI as your competent professional, then the whole thing just falls apart.
It falls apart because if there's no competent professional or no one who can be held out as a competent professional, there is no claim.
Treating AI as your competent professional is a big no-no.
I would say that would not cut the mustard.
What else? What's the future outlook for the R&D tax credit regime in the UK?
We have a new Prime Minister and we don't really know what's going to happen. There's a few factors at play here. First of all, from what I understand, John Healey, the new Chancellor, was part of Gordon Brown's Treasury team. And of course, it was Gordon Brown as Chancellor who introduced R&D tax credits way back 26 years ago. So maybe there's a little bit of ownership that comes through. Maybe they understand the benefit that it can bring to the UK. There's a further factor as well. As I mentioned before, there are roughly 50 jurisdictions globally that use R&D tax credits to incentivize growth in other countries. The problem with intellectual property that's being developed in the UK is in many cases it's intangible and it is transportable and it could leave the UK.
You want to make sure that it stays put and generates value into the future.
The risk is that other countries will get the benefit. Because if other countries, say France has a 30% tax credit, Ireland has a 35% tax credit, Canada I think goes even bigger than 35. But if a company goes from the UK and takes their R&D to another jurisdiction, it could actually reduce growth prospects in the UK just as we need them.
So completely and utterly backfire.
Yes, and it's a risk. That is a fear reason why the revenue and the government should keep R&D tax credits in the UK. Every Prime Minister wants growth. If there was massive growth in the UK, then maybe we could afford a little bit more of the spending plans. The government has an industrial strategy, and there are 8 core sectors within the industrial strategy, and some of them are very well rehearsed. You've got fintech, AI, digital, advanced manufacturing, defence, life sciences, and a couple of others, clean tech. They have correctly noted that the key tax levers supporting those growth areas are R&D tax credits, are patent box, and are, for the creative sector reliefs. But the largest of those, from a cost perspective for the government, is R&D tax credits. And these are focused on growth.
It's literally like a government fiscal injection into the economy focused on R&D.
Yeah.
With the view of growing the economy.
Yes. And if you look at the R&D tax credit and how the financial calculation works, the largest component of the calculation revolves around salary costs.
Staffing, yeah.
Staffing. So the theory, and this is logic, this is good theory, is that the more you spend on R&D staff, the more the R&D claim value is. However, if a company just has a flat spend, then it can claim the same amount of R&D tax credit year on year because of the way the rules work. Where's the growth in flat spend? Maybe there should be an element of core spend which is subject to a lower rate of R&D tax credit.
And have some sort of incentive to expand that spend. and as a result actually affect
at a higher
growth.
rate of relief. But maybe after 2-3 years, there is a constant spend level now appearing. Or maybe now that it's constant, they've had their accelerated rate of relief. Why not give that level a lower rate of relief, tax credit, but anything over and above that rate, I mean, subject, of course, to de minimis changes and materiality, etc., 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 can trigger a higher rate of relief. That way, we can now directly align the tax lever, the R&D tax credit tax lever, to growth. And I think that's what's being missed.
Very interesting idea and perspective. And I guess you could also use this kind of layered incentive specifically targeting the IS8. There's no additional rates for them.
There's not. If, say, for example, a company is involved in some form of, for example, software development, but doesn't meet the IS8 criteria, maybe they should have a lower rate for their projects, but maybe one step at a time.
Stephen, thank you very much for joining.
Thank you for asking me.
That was the second episode of the Refine podcast. Thank you very much for joining.